We'll be starting in just a couple minutes. If anybody wants to get dessert or coffee, now would be a good time to do it. Just one operational note that I hope won't disappoint too many people. The finance minister of Colombia at the last moment had to cancel his trip to the U.S., so he will not be joining us today. That means we're just moving everything on the schedule up a bit, and you will get the benefit of all the deep analytical thinkers as opposed to the powerful people, which on balance I think is probably a good thing. So that means we're going to start with our Latin American panel, have a coffee break at 1:30-ish, move on to our emerging markets panel around 1:45, and then get to our CIS panel at around 3:30. Oh, excuse me, at around 3. And all of you will be let off early for good behavior. This is the, I believe, third of our semi-annual Moody's Investor Service Peterson Institute for International Economics sovereign risk panels. The Peterson Institute generally doesn't do a lot of co-branding, but in this case we've been very proud and delighted to do it with Moody's because it's been a straight-up mutual exchange of ideas. We do our work, they do their work, and we come together to compare perspectives, both informally, off the record together, and in meetings like this to present our views around the time of the spring and fall IMF World Bank meetings. Today, we're going to be focusing on two major issues, which is the spillovers on emerging markets of the QE tapering, of the Federal Reserve tightening policy, and emerging markets more generally. And second, looking at two critical regions of the world economy, Latin America and liberalization in the CIS, the Commonwealth of Independent States, which, despite the recent news, does include countries beyond Ukraine and Russia, and some of which are of some significance to the world as well. My partner in running all these is Lucio Vinhas de Souza. As always, I hope I get away with the pronunciation. My friend and also sovereign chief economist at Moody's Investor Service. It was his idea to start this set of programs. We're grateful to him, to Richard Cantor, to all the leadership of Moody's for continuing to support this effort. As always, each individual speaking from the Peterson side speaks in their own accord and with their own independent views. People speaking from the Moody's side have complicated legal disclosures they have to live with, and they will each explain them to you as they stand up to speak. You have my sympathies, but I'm glad you're playing by the rules. So, without wanting to rush my friends, I would like to ask Lucio to call up Mauro Leos and Jose de Gregorio for our first panel.
There is very little left for me to say after this wonderful introduction, with the exception of the legal disclaimers. Of course, we should take about 15 minutes. Now, I would like to call my colleague Mauro Leos and also Jose de Gregorio to join me in the podium. Some ground rules before we start. There is going to be 15 minutes presentation from all of us. The aim is to leave 15 minutes for every single one of you in terms of a Q&A discussion with the audience. I assume that some of us have PowerPoint presentations. We are starting, I believe, with Mauro, is that correct? Or with Jose? Mauro, you do have a PowerPoint presentation that you submitted. So I believe that if you want to control it adequately, you should perhaps come here to the podium. And we have here a beamer for you to do so. So, ladies and gentlemen, Mauro Leos. is the regional manager of our sovereign team that deals with Latin America. Mauro, please, the floor is yours.
Good day, everyone. Thank you to the Institute for the opportunity to join you here. The subject of conversation for Latin America is between internal constraints and external tapering, trying to determine, figure out how these elements may have an influence in terms of the performance of the region in the near term and the potential implications for the following years. And I was trying to sort of define and understand how to look at internal constraints. The way in which we are looking at the region now, and now that there are several countries that have moved into investment grade, which means that we think that they're more resilient to the shocks, and not as exposed as they were before. They continue to be, but not as exposed as they were before to particularly external financial and balance of payment shocks, that the role of domestic factors has become more important in terms of those countries' performance. Now, I have to emphasize that I'm going to be speaking maybe more about the investment-grade countries, because there are other countries where the problems are, to some extent, not that different from what they used to be years ago. Some countries look about the same way they looked 10 years ago. So I'm going to be focusing more on those that have been able to make the leap and go into investment grade and therefore to significantly improve their performance. But I will be taking a look at the whole region. So the way in which I think we define the constraints, the domestic constraints, have to do with, well, potential growth, which we think is a very important consideration. The fact that the region as a whole reported high growth in previous years, high above potential growth, and that now we're seeing that an adjustment in terms of the growth that one should expect for the coming years, coming back towards potential, and in some cases going below potential. A very important factor in this respect is the role of infrastructure. The other thing is the fact that we think there's limited policy space on the fiscal front, in some cases on the monetary front as well. And because of that, as conditions change in terms of the international environment, some countries will not be able to compensate as much as others for that change in conditions. And last but not least, an element that is not explicitly incorporated into the presentation but is relevant is the internal constraints that are related to social inclusion and the higher demands of what we see as an emerging middle class. I think that the case where this is more evident is Brazil. And we've seen that in action during the year. But this is sort of, and to some extent in Chile as well. Well, that's a slightly different story from that of Brazil. But the point is that once you deal with the subject of macroeconomic stabilization, then there are other types of demands that are present and that pose important challenges in terms of the internal constraints. So let me see if I figure this out. There. The talk, you know, when you hear about emerging economies in general, and Latin America in particular, is that the fact that growth is going to be lower than before. And that is, I think that is sometimes presented or perceived as bad news. And of course, it's always better to have high growth. But the way we look at this, the region as a whole, and some countries in particular, were clearly going above potential. And therefore, it was only to be expected, regardless of what was going to happen, that growth would come down. In order to give you a sense as to what we're talking about, what I have here is the whole region, okay, from top to bottom. And this is growth in the post-2009 era, 10, 11, and 12. And if you go back to the pre-2009, the numbers were also impressive, high, in most cases above trend. But in this case, I'm focusing on these 3 years after 2009. As a reference, what I have here is 4%, that I guess has been viewed at one point in time as the trend growth, potential growth for the region, a good reference for the region as a whole. So what is interesting, what is telling is how many countries during this period of time, this is a 3-year period after the crisis, were reporting over a 3-year period on average growth that was substantially above 4%. Okay? So this could have been viewed as an indication that this is the new Latin America, the one that has been able to overcome the 4% limitation or constraint. And it was only 1 year, 2 years, but 3 years. At the very top, you have Panama, that grew during this period of time almost 10%. Actually, if you look at the 10 years, the last 10 years for Panama, we're talking about more than 8%. So something not that different from China, even though it doesn't get as much attention in terms of the headlines. The second one is Peru, that has always been a high growth economy in the region. But you can see that in this case, over this 3-year period, it was growth of almost 7%, which even by emerging economies, it's quite impressive. And then, a plethora of countries, Uruguay, Chile, Ecuador, Paraguay, all types of countries. Investment grade, not investment grade, those that have a high reliance on commodities, middle size, larger countries. The exceptions in terms of growth during this period of time, and there's, as is always the case, there are exceptions, were mostly located, and they continue to be located in the Caribbean. Okay? You have Cayman, St. Vincent, Jamaica, Barbados, and Martin, countries that have been growing at less than 2%. So the point by looking at this picture is that it seems to be that after the crisis, once again, there were elements in place that were taking Latin America to a different position in terms of growth, higher growth. This is what we have for 2014. And this is last year and our estimate for this year. Once again, the reference is, this is what it was, this is what it is, taken into consideration last year. You can see the difference, the significant difference in terms of how many countries were growing before, above 4%, and how many countries are growing now above percent. Just see. There are two that stand out. Paraguay and Panama. Panama was there. It continues to be there. It's driven by to a large extent by the Panama Canal, the construction, but it has been a high growth economy for the last 10 years. The case of Paraguay is very special. It's a very volatile economy. This has to do mostly with agriculture. And it's an economy where they reported very negative growth, and then they bounced back significantly last year. So it's an odd case, Paraguay. It was clearly not a high growth economy before. It just happens to be that for 2013 and 14, this is the peak in terms of that volatile cycle that we see in Paraguay. But then the others that we have, and I don't know if you thought about it, as high growth countries, once again, this is the last 2 years, Bolivia, once again, more than 4%, on the other about 5%, and Peru. Peru has always been there. Peru and Panama have always been there. They were there before, and they continue to be there. Then you have most of the other countries falling towards the middle part. And quite a few countries now were able to report growth of only 2% or less. So just once again as a reference, if you look at almost everyone during those 3 years was above 2%. There were quite a few. Only the problem countries were at 2% or less. Now, there are several countries that we have there. And once again, all sizes, all flavors, all colors. You have Mexico at about 2%, Brazil at about 2%. So the point is that clearly what we were seeing before, we think was not a reflection of the real Latin America. The real Latin America is stronger, more resilient, but in terms of growth, there are still important constraints and limitations. And what we're seeing across the region is that adjustment towards lower rates, but more in line with potential. Once again, the other thing that stands out when we look at the last 2 years is that there are a few countries where growth is at less than 2%. Barbados, negative growth over the 2-year period. And the common denominator for the group of countries is that Most of them are, as I mentioned before, in the Caribbean. The exception there is Venezuela. You know why? And El Salvador. El Salvador has always been, for a long time, a low growth economy, of growth of about 1%. Okay, but the problems in terms of growth are concentrated in the Caribbean. What we have here, just to contrast and to present the same information, is in the same graph, you have growth for the last 2 years, last year and this year, which we think is a good indication of what one should expect for the future, and the reference of the post-2009, which once again was associated with above potential growth. So you can see that and the dots, that's the latest numbers, the bars, that's the reference, and the post-2009 reference. So you can see that with few exceptions, and the exceptions in this case are the green ones. The green ones are countries where growth last year and this year is going to be higher than what it was post-2009 during above trend. Exceptions are Paraguay, Bolivia about the same, Trinidad, Tobago, and then those that are at the end of the spectrum, you don't pay too much attention to them. The things that we're doing so bad that now they're doing better. But almost everyone is doing as well as, if not worse than before. So that's where you have the red dots. And that's an indication, once again, that growth is coming down more, reflecting the internal constraints. The two countries that stand out in terms of the difference between how much they were growing before and how much they're growing now are, that was the wrong button. Okay. Okay. Do I have a pointer here? Yes, here. Okay. Well, Uruguay and Argentina, both were growing at more than 6%. Now, in the case of Uruguay, it's growing at about 3%. In the case of Argentina, about 2%. So it's a major deceleration for those countries. Once again, those are exceptions. For almost everyone, we see lower growth. And this is just another way of looking at this information. What we have here are all the countries for which growth last year and this year is going to be lower than what it was before. That is what we have called the deceleration factor. So this is the comparison between average growth in these 2 years relative to average growth in those 3 years, 10, 11, and 12. And you can see, as I was mentioning, that in the case of Argentina and Uruguay, the difference is significant. In terms of average growth, in the case of Argentina, 4.5 points less in terms of annual growth. In the case of Uruguay, about 3. And then several countries where growth is going to be 2 to 1 point lower than before. Once again, when it comes to our views of the countries, we do not see this necessarily as negative. We just see as an indication that once they're moving towards potential, and therefore the question has to do with what are the elements that will determine potential growth in the coming years. The focus, well, there's an obvious one that has to do with infrastructure. A lot of work has been done in the IDB in terms of the role of infrastructure, and everywhere you go, this is what you see. But the other point that we have emphasized is the role of policies and the role of reforms. I think that the case where we illustrate this better in terms of the medium-term implication is Mexico. In the case of Mexico, we did an upgrade to an A rating. Before that, the only country that had gone into the A range had been Chile. Chile is now AA3, 3 notches below the AAA level. But in the case of Mexico, we emphasized the role of reforms. So we think that in terms of, in addition to external conditions, for the purpose of sustained potential medium-term growth, the role of reforms and policies is going to be important. Significant progress has been made when it comes to the fiscal side in some of these countries. In some cases, there are rules in place, fiscal frameworks that are trying to be more counter-cyclical. And the question is if we're going to be able to operate that in the coming years and how much of a benefit that is going to provide. In any case, once again, our view is that this is part of a natural process and that there are internal constraints that will limit growth in the coming years, but that will be just coming towards potential. With regards to tapering, 2 observations. First, most of the attention in terms of tapering has been focused on the impact on the balance of payments. Our view is that for several countries, balance of payments risks are not as significant as they used to be before. And generally speaking, we've shifted our attention in terms of looking at the countries from looking at balance of payments to looking more at the fiscal accounts. For looking at the balance of payments, we're looking more at financial systems, financial regulation, things of that nature, create the possibility of credit booms and the risk that they pose. So when it comes to tapering, our view is that the impact, we think, or at least in terms of the analysis that we do, we find that to be more significant when it comes to funding costs for governments, and the same would be true for other issuers locally, whether they're corporates or banks. So it's moving away from the balance of payments and towards funding.
Subject to funding, we can always use new IT.
Okay.
That was an infrastructure constraint.
This is, our view with regards to tapering is the following. It is true that it's going to have an impact in the coming years, but what we saw for most of the countries in Latin America is that it already had an impact in terms of the adjustments that we observed in exchange rate last year's, in terms of the adjustments that we observed in spreads, both sovereign spreads and the spread that other borrowers were paying. So a large part of that adjustment is already in place, and that was related to the announcement that were made by the Fed last year. Of course, there will continue to be an impact in the coming years, but the point is that a significant component of that adjustment is already in place. And if you have been following the currencies, there was a deterioration at the beginning, but now they have appreciated, most of them, their flows coming in the last few weeks. In some cases, because of increase in domestic interest rates, as it is Brazil. In others, because apparently there's a recomposition of portfolios towards Mexico, towards Colombia. One thing that has been a concern is the impact of tapering in terms of international reserve positions. So far, we have not seen that in the region. Although there's a problem here looking at the numbers, because you have Brazil on the one hand with huge reserves on the others, but what we wanted to highlight that you don't see a significant difference in terms of, at least in the near term, in terms of the impact in terms of for our international reserves. And there's one indicator that we use that we call a EVI, External Vulnerability Indicator, that relates the level of reserves, the coverage of external debt payments by reserves. What we see in most of the countries is that the coverage is sufficient, more than adequate, and higher than what it was before. And we have not seen a significant difference between what it was last year and what it is now. We find it hard to believe that there will be an important deterioration, and that is why we're not that concerned about the balance of payments component. What we have seen, and this is the way in which we are looking at tapering, and with this I will conclude, is the impact that it has had in terms of the yield curves, and this is for sovereigns, for governments. You have here, in the case of Brazil, and I have three countries, Brazil, Mexico, and Chile. And I have both the global yield curve for US dollars and the local yield curve, in the case of Brazil. So you can see in both cases, and this is what we have here is, you can see the lower one reflects the yield curve as it was in April, the end of April last year. The upper one is, well, the last number that we have here was for the end of February. But things have not changed that much since then. So what we saw, and we see this as an effect of tapering, at least the initial impact, and an important one has to do with the higher costs for governments, not only in the international markets, but in the domestic markets as well. And this is another new development in the region. The fact that non-residents, the increased presence of non-residents in local markets, in local market debt, across the region, in some countries more than in others. So that means that there's another channel by which tapering is also going to impact the financial performance of the governments, and that is through the role of non-residents. So what you see in the case of Brazil, an increase in both yield curves, much more in the case of the domestic curve. Part of that is related to the increase in rates by the central bank, but there's another component that has to do with non-residents as well. And we see the same pattern when it comes to Mexico. Not as significant as that for Brazil, but you have the same thing, a shift, an upward shift in terms of the yield curves. In the case of Mexico, even though the Central Bank of Brazil, they have increased, but you know, significantly interest rates, the Central Bank of Mexico has not. However, in spite of that, there has been a shift on the yield curve. The way in which we look at that is we see that as a reflection of tapering in the Mexican markets, coming once again through non-residents. The last.
Perhaps you should indeed conclude, because one would assume that an A-rated sovereign can abide by time constraints, right? The last curve and the slide I'm going to show you, and with this I conclude, is Chile. There has been an upward shift as well, but what is interesting is that we don't see that in the case of, and there's not that significant when it comes to the local yield curves. A thing that we believe is that and we're exploring this idea, if Chile is becoming sort of a regional safe haven, where flows, that is viewed differently from the rest of the countries. In the case of Chile, what is clearly different is that when you talk about the government, we're talking about a highly rated government, a AA rated government. So to conclude, once again, in terms of internal constraints, we see them as significant, and in the context of lower growth for the coming years, with increased emphasis on policy frameworks and reforms. And with tapering, our concern, and we think that the impact so far has been more significant and will be during the rest of this year and in the coming years in terms of yields, both yield curves when it comes to global markets and domestic markets. Mauro, thanks so much for the timely discussion. I would like to ask Jose to go to the podium now, and we will do the questions for both presentations in the end. Jose de Gregorio.
Thank you very much. It is supposed that the presentation will appear now. So this is. Thank you very much. It is a pleasure to be here and to be able to discuss with Mauro the outlook for Latin America. I'll basically, this was not supposed to be, well, sorry, it was my mistake. I will talk a little bit about the global environment for emerging markets and in particular for Latin American economies. Then I'll discuss some of the regional outlook to then do a couple of concluding remarks. So, when our worry about the emerging markets and all the discussion about emerging market, of course, start with the tapering, but this is just as a continuity. This is a graph that I have presented many times to say, well, Latin America did very well after the crisis. For the first time, it was not the green line, it was the blue line. If you look at all crises in Latin America, we used to be the green line. That was now advanced economies, and Latin America is the blue line during the crisis. However, things now and the economies are slowing down, and of course there is much more tension than we're out already from the crisis. And this start with tapering, or perhaps this is the discussion for emerging market, that basically caused two things: a rapid increase in interest rate in the U.S. and a flight to quality that reduced the appetite for emerging market assets. The spreads went up, and of course, more recently, and if you see just at the end, there has been a return of risk appetite for emerging market, and this is very consistent with what's going on with the exchange rate that I will just show you now. What we have is that when tapering was announced, there is this irony that early 2013, there was all this discussion about currency war. And all emerging markets say we're in a currency war, the ultra-expansionary monetary policy in advanced economies is killing us. And then in May, the Fed announced that there could be tapering. It was not start tapering. They said there is a possibility that we will start to taper the ultra expansionary monetary policy, and we saw what happened with the spreads, interest rate, and a sharp depreciation in, this is the BRICS, in most emerging markets. So depreciation here is up, not like in the figure by Mauro. So we have a very sharp depreciation in very few months. So it seems that now the discussion after May 13 was not about the currency war, was sorry, we were joking. We were happy with the strong currencies because we had what we want, a sharp depreciation and a gain in competitiveness in most emerging markets, except, of course, the case of China. Most rapid in South Africa, but Brazil, you can see the blue line, they have a sharp depreciation, then they slow down, then the exchange rate have appreciated again, and there is a time, now we are in a time of tranquility. This happened also with all emerging markets, and if we go Latin America, there is the red line, is Chile, then below is Colombia, that moves very close to Chile, and the orange line, which is Peru, usually much more stable because they intervene a lot. If you see the rest of emerging market, of course you have Turkey and Indonesia in one extreme, and you have Malaysia very calm for the rest of the time. But we have seen basically a movement from very strong currencies in emerging markets to very weak currencies or relatively weak currencies with the prospect of weakening even further in emerging markets. This, of course, puts some pressure on inflation, and this on interest rate and financial conditions deteriorate as expectations that there won't be much more space for monetary loosening. Indeed, if we see a summary of Mauro's figure before for all these countries, here we have the depreciation of the currencies in a bunch of countries. Commodity exporters, I have always Australia and Canada, and some Asian, and the blue are the Latin American countries. What we see is that as they depreciated, of course, domestic and the domestic yield curve, domestic interest rate, this is a 5-year government bonds, went up quite important. Of course, the extreme case was Turkey, but also a case of Brazil, South Africa, Indonesia, and Russia. The only exception where interest rates have come down is Chile, but that's also, it's not just the high-grade quality country, but it's also that it has cut interest rate for almost 100 basis points in the last few months. So this is a natural response of monetary policy. And we saw this bunch of countries, Canada and Australia, that they haven't had that much repercussions on interest rate, the case of Chile. So moving around zero is not a big deal. And so we have this sharp depreciation. So let's go. This is basically what has going on in the world. Tightened financial conditions on the emerging markets, depreciation of the currencies, commodity exporter, and there is also doubts what will be the implications of China on commodity prices. So this is, of course, causing a slowdown in the region. This is a summary of growth. I have 2 lines for Latin America. I always use simple average because when you do average weight by size, the average is Brazil. So Latin America becomes Brazil, and we don't want to be just Brazil, except for soccer. But then, so we have LATAM is 11 countries average, the list is there, and then LATAM 5, which is the 7 largest countries, excluding Venezuela and Argentina, because it's very difficult to tell stories, common stories with the rest of the LATAM 5 are the countries that with sound macro policies and with inflation targets, which are Brazil, Chile, Colombia, Mexico, and Peru. So, but you see that they grow relatively the same. Brazil has started declining growth since 2011, and Mexico this year had 2013 was also a relatively bad year. So what we see is that a sharp rebound from the crisis, and then growth has started to slow down. Here we have a summary, which is always very confusing, so many numbers. I just want to call your attention to this, the slowdown. We see slowdown in most countries starting 2011, 12, or even 13, most of them between 12 and 13. Brazil started before in 2011, but then we see Argentina and Uruguay that are next to each other, and they co-move a lot together. And just already Mauro showed us the decline in the rate of growth. They started slowing down just by looking at figures. There is not that much statistics here. Argentina and Uruguay in 2012. And 2013, we have the rest of countries that have been slowing down from growth. Chile from close to 6%, 5.5% to 4%, and 3.5% this year, probably. Mexico, that has a declining growth in 2013, and now it's growing a little bit better. Peru, which was kind of the highest growth country in the region, now is coming down to normal, rate close to 5%, but this is all, and then you have Venezuela, which is a special case. The thing that I want to point, well, the case of Mexico is also special in a way because it's implementing reforms. There is more optimism that they can go back to rate of growth close to 3% for the next years. Last year, they had a fiscal problem. Basically, they have a tax increase without being able to implement rapidly the increase in expenditure. So they really have a sort of a lot of fiscal drag. And then what we see is that, which is something relatively normal. What's going on in Latin America? Two things. This is cyclical. This is in a way normal. Why? Because Latin American economies have no rate of long-term growth of 5 to 6% to say that the rate of growth that they had after the crisis would be permanent for a long time. They should come back to rates that are normal, between 3 and 5 at the most for most of the countries. And on top of that, with the rapid recovery, also they had a boom, not so exaggerated as before, but now should come with a slowdown. So nothing, I would say, extremely different. Now the issue is whether, and this is the big concern, of course, whether Latin America will be able to keep a normal slowdown, or this will represent a more deeper decline in activity and crisis, things that we were very used during the past. And let me just show you, this is monetary policy. There is still monetary policy space. We see, except in the case of Brazil, for countries that follow inflation target, that they have been cutting rates, and most likely they will keep cutting rates. They are far from the zero lower bound already, but rates are quite low. The case of Brazil reminds us how inflation targets work. Brazil is having inflation, is having significant increase in inflation, and they have been raising interest rate in order to be consistent with their inflation target, despite they are growing at rates close to 2%. But it's always important to remind that inflation target or price stability has not to do with the rate of growth. It has to do with the excess capacity. And Brazil is an economy with very low increase in potential output, so they are very close to full capacity. They are with record low unemployment rate, so of course Brazil cannot grow more if they do not expand on the supply side, because they have been growing based on demand, so they have inflation and they have been raising rates. To some extent also, Brazil is a country with an impaired transmission mechanism of monetary policy, because it's one of the few countries in the world where the monetary policy interest rate is not the lowest. It's kind of quite high. They are at 11, but development banks lend at 6. So monetary policy is kind of run outside, or credit conditions are a bit run outside the central bank. And the main mechanism has to do with exchange rate. So they tighten a lot, and this keeps an appreciation, which I don't think that is the soundest monetary mechanism, but that's kind of the challenge that they have. If we see monetary policy, and this is a graph, I still don't know what I want to make with this, but I did it and I found it nice, that's all. But this has the inflation target, which is the bar, a dot in some cases, a red dot for inflation, monetary policy rate, a blue dot, and the yellow, the inflation target. What we see here is many countries after the depreciations have had some increase in the yellow. So inflation expectations have gone up, and these have tightened financial conditions. We see the case, for example, in Latin America, the case of Mexico, the case of Brazil. They are with the inflation expectations very close to the top of their inflation target, not well centered in the inflation target, like in the case of Chile, like in the case of Colombia. So then you have all for the other countries. The other thing that's important, well, inflation, the actual inflation is not that important for the graph. Real interest rates are quite low. If we take inflation expectations and monetary policy rates, quite low. But there are two exceptional cases. There are two countries that have been struggling within emerging markets with the tapering, which is Brazil and Turkey. And these are two countries with sort of very unconventional or two unconventional monetary policies. In the case of Brazil, I already mentioned, they don't have a very well or broad monetary policy transmission mechanism. And in the case of Turkey, what we saw in the last few years was that Turkey was basically doing non-conventional monetary policy with very low interest rate. But then at the end, they have to surrender and to say, well, this is not enough, and they have these huge hikes in interest rate to come back to normal monetary policy. So I leave you with that graph, but will be on the web, I hope. A couple of other things. Fiscal, I look at fiscal have deteriorated. We had good luck. One of the things that Latin America had beyond doing good policies before the crisis is that we had a very high boom in commodity prices, economies booming, a lot of revenues, very good fiscal. However, have deteriorated. The fiscal space today in the region has been reduced. Not in a very large magnitude, still the fiscal, and here you have in the Latin American countries, still the cyclical adjusted fiscal deficit is not that large, but economies they are not in the same position as they were in 2007 before the crisis. The same we can see for public debt. Public debt in Latin America is not too high. It has increased. There are issues of credibility, and this is also related to the tightening financial conditions. The last thing that already Mauro also talked was the external conditions. There is always a discussion of current accounts in Latin America. I don't worry that much when you float your currency. When you float your currency, and this is what we have seen. What we have seen is that the current account, of course, with a decline in terms of trade, they have widened, and also with lower public savings, but they are still quite manageable, especially if we take into account that exchange rates have been adjusting. If you compare the current WIO with the previous WIO, on average, countries are, in emerging markets, the adjustment is going on, the current account deficit are declining, and so we don't see a very big shock. Indeed, I think that I'm relatively confident about Latin America in the sense that we won't have a big crisis in most countries. But we won't have a big crisis in most countries because we know at least we have some things, which is some clarity on the need to have a strong fiscal policies and strong monetary policies and a sound financial system. Of course, and flexible exchange rates. I think that those are the key to, not to avoid, but at least to mitigate crisis. There is all this discussion about the indices of vulnerabilities, and we always put a regression, compute coefficient, and then create the Gregorio coefficient of vulnerability, which would be my regression. I think that the most important thing is not the state of some state variables. So I think that much more important is the policy framework, and I think the policy framework have improved a lot. Having a flexible exchange rate is quite as important as having a lot of reserves. So I think that's good. Let me just conclude with a very few remarks and summarizing some things. Slowdown is cyclical, but and normal, we are having a more normal business cycle, but also weaker external conditions for emerging markets. Now, long-term growth in Latin America is not high. We are not Asia. We are far from being Asia. There are many things we can discuss a lot, but we can go from high long-term growth countries in Latin America, maybe 4.5 for cases like Chile or Pacific, Peru. Okay, Peru perhaps closer to 5, to countries like Brazil that are closer to 2, 2.5. Those are what they can do. So that's one of the main needs of the region, which is to foster productivity growth, to do reforms, and to do, in Mexico, they are doing in the energy sectors, things that are pending and are quite important, But this, we cannot forget the importance of macro. Macro policies and good macro policies save us from the big financial crisis. Before, in the past, I always said, in the past, whenever the world had a flu, we got pneumonia. This is for the first time the world had pneumonia and we got the flu. So hopefully we keep doing that. But there is one thing that I think that is the political policy risk that is underlying the region. Mauro already mentioned in Brazil, in the case of Chile, and it's a region with a lot of inequality. And then as you grow, as you become middle-class country, there is much more demands for equality. And at the beginning, is you just worry about jobs and growth and living poverty. But then there are much more needs of equality in a region that is the most unequal in the world, together with Africa. So this is the most unequal parts of the world. We're not talking about changes in advanced economies. We're talking about regions much more unequal. And the risk is social turmoil if you don't tackle these problems, or if you tackle them bad. The risk, of course, is populism. It's just to do some fiscal redistribution without doing a serious effort to increase opportunities. Thank you very much.
I would like to thank José and for also this additional confirmation that Chile is the good student of Latin America by abiding strictly by his time frame. So with those complimentary words, I would like to open the session for questions from the floor. We have roughly the next half an hour for that, and I see Wilhelm there with his hand, and after that the gentleman here. Wilhelm, please.
Just waving at you, actually, but yeah, it's all right.
Well,
since I
you
got
are
the mic,
entitled to that. We have known each other for 15 years. So,
I'd like to comment on interpretation of Brazil's monetary and fiscal stance. You point out correctly there's a huge wedge between the central bank's policy rate, now 11%, with, what is it, inflation's just over 6%. That should be enough to attract money from the moon, incidentally. The development banks, actually plural, lending at 6%. First, the sort of discretionary marginal cost of funds is governed by the 11, right? The 6% that the development banks charge is, has a large amount of simply rationed quasi-fiscal subsidy in it. Now, this has implications also for the interpretation of the fiscal stance. I long have in emerging markets, Brazil still sort of lingers and is likely, given the middle income trap it appears to be caught in, to linger for a lot longer, to look at a fiscal stance not through the, say, cyclically corrected fiscal deficit for the general government, but for the general government including the development banks, sometimes all state-owned banks, and then treating all net lending by the banks as grants, right? Which is basically what it is. And in that case, you have a very expansionary, much more expansionary fiscal policy stance in Brazil, and that combined with this very contractionary, the most contractionary monetary stance in the known universe, right, makes for a country that has the most spectacular mismatch of monetary fiscal policy, both growth unfriendly. Would you agree with this interpretation?
I would suggest that we start with Mauro replying, and then José. Mauro, please.
I don't know what to reply other than I agree with most of what you said. I guess that the only other observation that I would like to make is that you were talking about the wedge in terms of interest rates, and Jose Gregorio was talking about the difference between the policy rate as a leak and the BNDES rate. At the same time, the other thing is that it used to be the case that public sector banks represent about a third of total lending. Now they're captured about half of that. And it seems to be that that's the way it's going to be from now on. So that's a major shift. At the same time, you have the non-public banks, the commercial banks, where there's also a big wedge, but in the opposite, I mean, in the other direction, because the rate that they charge is astronomical, and it has always been like that, no? So that's I think one of the elements in terms of the distortions that are peculiar about Brazil and the way in which the financial markets operate, because at the end of the day, we're talking about potential growth that has to do with to transfer savings and make them into investment. One thing that we don't see in Brazil is long-term savings, which may be one of the explanations why investment is so low. In our rating universe, most of the countries that we rate, whether they're high income, low income, investment grade, non-investment grade, most of them report investment ratios of more than 20%. In the case of the Asians, well, much more than that. Brazil is one of the few, one of the few emerging economies that has investment grade where the ratio has always been below 20%. You know, it's just a big effort to get to 20%, and that has to do in part with the fact that there are no savings, and the only the source for all practical purposes is BNDES. So that's another problem here in terms of how to promote long-term savings in order to be able to support investment. And I think that it boils down to an element of credibility, lack of policy credibility. There are questions in terms of fiscal credibility. There are questions in terms of monetary policy credibility. So there are all these elements in place in Brazil that make it a very strange country in many respects. And in that context, the country has not changed really that much from what it was before. It has, once again, when it comes to its ability to handle external shocks. But in terms of domestic policies and in terms of the financial system, the level of inflation is lower than before, but all these contradictions are still there. You're right in that respect.
William is completely right. I didn't say, but the counterpart of there is a opportunity cost is the Selic rate, and the difference is a subsidy. Now, when you try to look at the numbers, I understand that the IMF and most numbers include the subsidy, the difference in interest rate, and that they say that it's about 2 percentage points of GDP because it's relatively small credit in the case of Brazil. It is a problem. I think that it is a problem also for monetary policy, because at the end you only end up affecting the exchange rate but not affecting credit conditions, because that is and as Mauro said, they went from 1/3 to half of credit being intermediated by national bank development banks, which nobody agrees to remove this subsidy, because it's a very good for all politicians in all regions to have some stake at these banks, and that's a serious problem that is related to the structure and the more deep structure of the Brazilian economy and how to run macro.
I think that we had a question there too.
Hi, Jose and Mauro. Thank you very much for coming and talking with us. Chris Faulkner McDonough with Ziff Brothers Investments. So a question for Jose, because you had a really interesting companion set of charts. The first was on essentially kind of inflation expectations, the real rate, then the policy target for across countries. And then the second companion chart was, I think, the similar countries, but with changes in the current account deficits or current account positions. Could you just, wasn't able to catch it because you were going through it quickly, but could you just comment on the consistency of some of the dots that you had on those charts and the movements in the current account positions? In particular, if you think that the inflation expectations have moved up, real rates are low, current account deficits are widening, then that suggests domestic demand is probably too strong and interest rates should be going up, not down. Yet you seem to be indicating that we're in a cyclical position that would give reason why, the Chilean central bank is cutting rates and others may soon follow. So if you could just kind of wrap that up and how you're seeing that and where you see it most at risk. Thanks.
Yeah, you're right. You're right in the sense that what we would see more recently, because I don't have the changes, and this is so what we see is increasing inflation expectations, monetary policy stay relatively constant, so a decline in real interest rate. And current accounts have not been widening. And current accounts have not been widening because what's going on the background of this is a slowdown of economic activity and a sharp depreciation of the exchange rate. So that's, I think, that has been the dominating effect on the current account of most countries. I haven't, I try always to use the same countries, commodity exporters. I always have Canada and Australia because we would like to be like them, and Latin America and some Asian countries. And I haven't gone through the details, but just by looking overall at the average of, there has been a narrowing of current accounts in emerging markets because of this depreciation and slowdown.
Further questions, please, and when you ask the question, please indicate if you have a preference. Ottaviano there, please.
Ottaviano Canuto.
And if possible, indeed, identify yourself for those that don't know you.
Ottaviano Canuto, World Bank. One comment and one question. The comment is the following on what William mentioned. He's right, but I should emphasize that this reflects the abnormal combination of fiscal policy and monetary policy in Brazil, as it is today, is not the normal state. It has been on in the last 5 years. Keep this in mind. The way Mauro addressed it as if it was a constant feature in the case of policymaking in Brazil. And it's important to highlight this because all the odds point out to a return to this kind of policy, whoever wins the election this year. So I would like to make this comment. Brazil has been abnormal, but not always abnormal. The second is more of a question. Instead of comparing GDP growth rates, shouldn't you look more at GNP growth rates? Because in the case of some of the smaller countries, the GDP growth rates reflect a bit sometimes abnormally high investments that are too big for those small economies. I have in mind the pulp mill in Uruguay. I have in mind the canal, Panama Canal reform and so on. So we're looking at GDP growth rates, putting them on the same, doesn't make much sense. That is a comment.
Mauro, Jose, anyone would like to try to take that?
Just one comment. I don't think that, first, Brazil policies are abnormal. They were abnormal in the sense that they have had this problem since long. Remember that they arrived at the crisis with rates close to 13%. And by that time, by 2008, I learned from some Chilean business people that they were borrowing at 6%. So the 6% is an old figure, and they have rates at 13%. So I think that it won't be easy for them to get rid of this and have more normal policies. You are completely right. You're completely right. For the small countries, even if you go to the 11 largest countries or the 7 largest countries of the region, the participation of foreign ownership is not that large. Let's take the case of Chile, which is maybe a couple of percentage points of GDP, 2 or 3. The ownership of the mining sector, which is a very with a lot of foreign participation. So I don't think that it would make a lot of difference. But in the smaller countries, I fully agree. Panama and the canal is of course a prime example.
Just a quick comment. Moving away from the discussion of if it's normal or not. Maybe that's not the right terminology. What we have seen in the case of Brazil, and that continues to be the case now, is that it's clearly an outlier, and it has been an outlier when it comes to real interest rates. And there are several explanations of why that is the case. Institutional memory and hyperinflation before, or lack of. The point is that it's one of the few countries where there are clear outliers in this respect. One of the arguments was that it was becoming a more normal country in that respect, with real interest rates coming down, but apparently that didn't work. This time they're back up to where they were. Now, the way in which we look at Brazil is that it's like a country and economy where there's limited policy space, both fiscal and monetary. And this was true before, and even though there have been significant changes in Brazil in different areas, that continues to be the case right now. In very simplistic terms, there's limited fiscal space, among other things, because debt to GDP is high, 60%, because the interest burden is high. This accounts for about 15%. Interest payments account for about 15% of government revenues. And it's also, there's limited policy space because tax revenues are already quite high. So the discussion in Brazil is how to make the tax system more efficient and how to lower taxes. And actually, this administration has done part of that when it comes to, particularly to payroll taxes. So there's limited space on the fiscal side, and a large part of the fiscal side is driven by pension payments. So it's a structural condition. On the monetary side, there's limited policy space because even though you saw the interest rate where Jose had it, inflation has always been close to the top of the range, the 6.5, 2.5. So there's limited policy space. I mean, there's not that much that they can do because they have to address that, and there's the element of credibility. So in that respect, maybe that's the way in which we are looking at Brazil right now, limited policy space, and the question as to how they're going to handle the challenges of low growth and high inflation, which is also a contradiction, with limited fiscal and monetary space.
Any takes on the adequacy of a GNP estimation for countries like Panama, for instance?
Well, you're right in the sense that there are countries, and more often than not, that will be small countries, specific countries. You mentioned Panama. That may be the case also for Uruguay. It also would apply for some other countries in the Central America that there's a difference between GNP and GDP. To be honest, we have not made that distinction. And one of the limitations that we have as Moody's is that we have to have the same standard for all the countries. So at this time, despite the fact that there may be some exceptions and some corrections that have to be adopted, our standard has been the GDP. But you're right in the sense that in some cases, a footnote has to be made as to the fact that GNP may be provide a better sense of the state of the economy than GDP.
The discussion about the normality of Brazil reminds me of the fact that years ago I wrote a book about Russia and called it a normal country. I'm still paying for that. The gentleman down there, please, identify yourself and who do you want to reply to the question?
Bill Klein from here at the Institute. Either Jose or Mauro, how do you think about these big swaps that Brazil has used to intervene? Because one of the ironies is that you see them curbing the extent of the depreciation, but the reserves don't budge. But that's the reported reserves without taking account of the swap activity that has been taking place behind that. Should we think about the meaningful reserve position as subtracting out those swaps so there's been a big decline? Or should we think of that as basically as long as you can bribe people with the domestic currency with a higher and higher price, you've still got those reserves?
Suggest that we start with Jose for this one.
This is for rating agencies. What do you do with derivatives? So this is the whole problem of what do you do with derivatives in your financial statements, and you're completely right. For some reason in Brazil they think that swap is a better instrument for intervention, and at the same time just keep showing high reserves, because as long as you can keep them rolling, you should be able. My impression, just by looking at the figures, is that those interventions are not very effective. So there is a lot of doing operations, but they have some. But everywhere in emerging markets, what has been more important with the recent appreciation in Brazil has been the decline in the MB and the hike in interest rates. So to make 11 on any country today, it's very good. So I'm not so sure. Now I don't have a very strong opinion. I think that in a way the swap is to try to not to have it on the official figures, but yeah, it's a problem. I think that let's see what the ratings say.
We should not be forcing panelists to reply questions if they don't want, but that would be appreciated in any case.
Just quickly, that's one of the peculiarities of how the central bank operates in Brazil. I think that a very important consideration has to do with the fact that this is not only the central bank, but Brazil, they want to show that the reserves are there, in spite of everything, 300, whatever. The other thing that you can argue, and this, this discussion has come up, is that if the use of the derivatives, the swap cambiado, is short-lived, it's only a temporary period during which you're trying to accommodate volatility in the market, then, well, it is okay if you do it that way, if there are no fundamental problems, and if you're not sort of pushing the exchange rate in one direction or another that is fundamentally different from that of equilibrium. But you're right in the sense that they're able to get away with more than other banks because they keep all the cash there, and at the same time they're able to intervene. In terms of how effective this is, I guess that maybe Jose is right. I really haven't seen that, and we have not done that analysis as to if that's more or less effective than doing it the other way. But this is the way it has been done in Brazil for a while, and it will continue to be like that, I think.
I can take one last question from the audience, if we have takers at this stage. If not, I would like to compliment Jose for a remarkable presentation, and also Mauro, representatives from the 2A rated countries that we have on the region that were... that's what I mean. But I have complete confidence in Los Estados Unidos Mexicanos from a long-term point of view, right there. This said, I would like to ask you to follow me in complimenting our panelists for their presentation. And now Adam will be kind enough to join us to introduce the next session.